guest. We have Brett Harrison, president of FTXUS. Thank you for joining us, Brett.
Yeah, thanks for having me. Good to see you.
So you have a keynote coming up this Thursday. It's called Disrupting the Traditional Financial Markets. Could you give us a preview of what to expect?
Yeah, absolutely. So I'm primarily going to focus on our upcoming derivatives exchange in the US, talk about our application with the CFTC to enable margin to be able to bring futures and options on crypto to US customers. But I'm going to bring it a little bit back from that and talk about the evolution of traditional market structure in derivatives prior to crypto, prior to FTX, and talk about the different ways that from a technology perspective, from a market access perspective, from a margining and risk perspective, that we are really disrupting the space there. And just talk a little bit about some of my background in proprietary phase. Yes, Citadel and Jane Street, and going from that proprietary trading side of it and all the things you have to do in order to compete in that space in the traditional markets to crypto, where everything is sort of flipped on its head. It's a lot simpler, easier to access. I'm going to kind of walk us through that a little bit.
Okay, very interesting. So obviously you are FTXUS compared to, by contrast, SBF, Sam Bankman-Fried, who you also worked at Jane Street with. He's running FTX, headquartered here in the Bahamas. So can you explain to me like the differences? And you've had to do it this way because of the, I imagine, more strenuous regulations in the United States.
Sure. So FTX, the global cryptocurrency exchange, was founded 3 years ago, and the goal was to be able to offer a better alternative for trading derivatives than some of the existing exchanges that were there. And to get derivatives able to trade in different jurisdictions, it depends on what licenses are required. In the US, you need a very specific set of licenses from the Commodity Futures Trading Commission, the CFTC. And otherwise, outside the US, the regulation wasn't as strict. In some cases, it was a bit ambiguous about what would be required, but we could offer derivatives in basically every jurisdiction but the US. So when we went to actually offer now a US offering around 1.5 years ago and started FTXUS, we needed to make sure that was a completely separate company from FTX that had different licenses to offer spot, to offer eventually derivatives, and that stayed completely separate from the international business.
So I wonder, with the sanctions in Russia, for instance, what does FTXUS have to do to abide by sanctions? And
Sure.
I mentioned, Bill Clinton is here.
Yes.
Hillary Clinton is famously not very favorable towards crypto, and has admonished crypto exchanges for not cracking down on Russian users more.
Sure. So first, FTX and FTXUS take the exact same position when it comes to international sanctions, which is that we do everything we can to uphold them. We are in constant contact with the Treasury, with different local, state, and national regulatory bodies, as well as lawmakers, to make sure that we're doing what we're supposed to do to uphold sanctions. So we look at things like the Interpol lists, the new FBI most wanted list, the OFAC sanctions list, and we make sure that any individuals on those lists, we block them from crypto and fiat deposits and withdrawals. In addition, we proactively blocked all Russian institutions and ruble transfers into and out of the exchanges. So from the very beginning, we've tried to take a stance of being able to block institutional activity, Russian money from flowing in and out of the exchanges, any kind of issues with OPEC sanctioned people. We've been on top of that from the very beginning.
Has there been any indication of, say, Russian oligarchs moving money around?
It's difficult for us to say because even before the conflict in the Ukraine started, we're blocking activity from sanctions individuals every week. This is sort of what we have to do, and it's not just from Russia. It could be from, North Korea, other different jurisdictions that are blocked. We're constantly in an automated fashion blocking those people because we automatically pull the lists, we do the screening, we make sure that they're blocked out, and so to us, it's sort of like a regular day for us to be able to block these kinds of users.
What about ordinary Russian users who have had to leave Russia because they disagree with the government there?
Right. So there's been no guidance from any jurisdiction that being either a Russian national or a Russian ancestry or anything that just has to do with being Russian means you should be blocked from participating in the ordinary financial markets. That has not been a step that's been taken by any government, including the US yet, in terms of this conflict. And so if that were to be the law that came down that we had to block all Russian users, then we would absolutely do it. It just hasn't been the diplomacy yet that they've been trying to play in terms of affecting this war.
I also saw you tweeting about algorithmic stablecoins, and you're talking to a lot of regulators. So I wonder, your thoughts on such stablecoins and navigating that route among the regulatory scrutiny that you handle daily.
Yeah, algorithmic trading stablecoins are really interesting right now because we see them. There's Do Kwon talked about having one, and then Justin Sun, and what's interesting about them is that they're not truly stable. Right? A stable coin, when I think of a stable coin, I think something like USDC, where you put in $1 cash and you get out $1 USDC. And it's very easy to think about because it's always going to be equal to $1 as long as you're sure that underlying those assets are actually dollars. For an algorithmic stablecoin, it's different. What you have is some other token that's not a dollar, let's say, that you're buying and selling automatically in order to keep this conversion rate close to 1. And that works until it doesn't. If there's a huge run on the asset, if people stop believing in sort of the faith and credit of that asset, it could go away. So we've seen things like, there was one called Titanium, I think, where the peg dropped, and this happens often enough that there's definitely risks to these things. And that's why there are high yields from these kinds of stable coins, because these are not risk-free assets. And so it's something that people have to keep in mind when they want to transact with them.
Well, that's very concerning because obviously Do Kwon has indicated that the Terra Luna Foundation is going to acquire $10 billion worth of Bitcoin one day. And should there be a run on the stablecoin, could that cause a domino impact on the rest of the crypto markets? Should something
I understand the goal there is to put as much of an asset backing to that stablecoin as possible. So let's say the stablecoin starts to drop, they can use those Bitcoin to be able to buy up that asset automatically and bring it there. And the more assets you have, the easier it is to keep it stable. Now, of course, anything can happen, right? And there could be a run, and maybe that requires them to spend a lot of Bitcoin to be able to do that. Spending a lot of Bitcoin maybe has a ripple effect beyond that. So I think it's possible and definitely something to be concerned about.
Do you think they're unsafe, these
I'm not yet at the point where I think they can cause systemic risk to the entire crypto ecosystem. But I do think for an investor who is using them as a way of legging into DeFi, for example, because they need some sort of stable asset to do so, or they want to try to get yields out of them, there's definitely risk and people have to be careful.
And is there any concern with Tron on top of that creating USDD, which is going to raise another Bitcoin reserve or whatever, crypto reserve, and 30% APY?
Again, I think that there's a reason why, I think if you go to a bank and you put your money in your bank, you get, a few basis points of yields. And then there's these algorithmic stablecoins that have 30% yields. There's probably some medium in between those where there's like a fairly safe asset that we can actually bridge together borrowers and lenders through DeFi that will give people much better yields than they would get at a bank, but also don't introduce sort of these risky plays. And I think that something like a 30% APY probably makes me a little bit nervous.
Well said. All right, before we take off, I want to point to these lovely cat pictures.
Oh my God.
And of your family that you have on your Twitter that we just love. I think you have 6 cats.
I do have 6 cats, that's true, and 5 dogs too.
And an adorable son.
Thank you,
so
thank you, thank you.
So it makes you very relatable.
Thank you. So, well, I think crypto is stressful. I think if you look at crypto Twitter, there's, debates over the future of CeFi versus DeFi. There's like all the news right now about Elon Musk and buying Twitter and what effect that's going to have and has anything to do with crypto. I think it's good for people to get a little bit of a break from that every now and then and come back to earth and enjoy a cat picture or two, and that's what I'm going for.
I think everyone could be down for a cat picture too. Brett, thank you so much for joining us.
Thank you so much.
All right.
Thank you so much.